Markets are very oversold now. You worked off a lot of that excess kind of exuberance in the short term. A lot of that negative breadth is now going to be in a position to start recovering. So you've actually got a very decent setup now, which is kind of what we talked about 2 weeks ago, is that, we're going to have that period of distribution that'll set the market up for that year-end rally.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my good friend, the bad banana with a greasy black peel, portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing fine. How are you today?
Good. I had a totally different adjective set up, but when you led here with the Grinch behind you, I had to go with an appropriate describer.
Exactly. Well, I mean, everybody's, all upset right now this week because of the Fed. So Jerome Powell is now my Grinch story for the week. So,
Well, we'll see. It's interesting. The market, unless you were sleeping under a rock this week, the Federal Reserve came out, did pretty much exactly what it promised to do, but then kind of spooked the market by showing its future dot plot, which showed that the Fed now expects to be reducing the federal funds policy rate at a slower rate than the market was hoping for. Market sold off pretty hard after the news on Wednesday. Yesterday, markets rallied, but then throughout the day, momentum waned and it actually closed red. Now the market's up pretty big. The morning we're talking here, Lance, on Friday, we'll see where it ends up closing. But yeah, that's the big question. Did Jerome Powell just turn the Santa Claus rally into the Grinch rally, or is the market just sort of getting over a little bit of heartburn from the change in expectation and everything's going to be fine?
actually, all that narrative about change in expectation, all that had nothing to do with the market sell-off on Friday. If you've paid any,
You mean Wednesday, right?
oh, sorry, on Wednesday, correct, on Wednesday, because if you paid attention, we've been writing about this kind of all week in our daily market commentaries, is that you had the worst breadth in the market that we've seen in months, and that's been going on for the last couple of weeks. You also had very negative sentiment starting to pick up on different technical fronts as well. So, despite the fact that the market was kind of hanging in there, we had talked about a couple of weeks ago here on the show that we're going into that portfolio rebalancing period. And last week and this week in particular is when all the mutual funds do their portfolio rebalancing, do their annual distributions. And so it's just, that negative kind of bias to the market was already there. It just needed a little bit of a push, so to speak, to get the sellers to go ahead and sell. And we saw it across all assets. So anything that had a gain this year got sold. Anything that had a loss got sold. And that's why on Wednesday, if you really think about it, Adam, if it was because the Fed changed their dot plot because they were expecting inflation to be more sticky, then why did gold dump by almost 2.5% on Wednesday? Right? Gold should have gone, that should have been a boomer day for gold on Wednesday if it was really a statement by the Fed that inflation is sticky, inflation's going higher. That wasn't the case. This was simply just a function that a lot of portfolio managers, just like us, were waiting to see what the Fed was going to do on Wednesday, and then we started buying on Thursday. So, we were just kind of waiting to get through that Fed meeting along with everybody else to see if there was any kind of surprise that came out of it. And there really wasn't. The Federal Reserve's been talking about, hey, they're going to cut rates. They're going to, as anticipated, and they're going to keep watching, kind of the data. And while they did shift the dot plot, and again, that dot plot is about as meaningless as anything that comes along because it's subject to the whims of change of data from one meeting to the next. But if you look at the longer run predictions going out to 26, 27, they're at 1.8% economic growth. That's down from 2 last year. And if you take and inflation rates are at 2, expectations for Fed funds are 2, nothing changed. So it was just the short-term pace that changed a bit, but the long-term expectations are exactly the same. So it didn't, the Fed statement was changed very little. There was very little change to their overall statement, and the outlook hasn't changed at all. So, but again, what's going to happen next year is they're likely wrong, and they're going to wind up cutting 3 to 4 times next year as the economy continues to slow down. And I would bet you within about the next 3 weeks, we're going to start seeing commentary from the markets suggesting that the Fed's going to start having to cut more than they thought. So, that whole narrative was just, I needed a reason to sell. Everybody was on one side of the boat. I needed to clear the deck, and that's what happened on Wednesday. So it was pretty meaningless across the board.
Okay, so yes, and going into the Fed meeting, you and I and pretty much every guest on this channel and I have been talking about how just incredibly optimistic market valuations were and still are, to be honest. I mean, leading into that. And so, yeah, maybe this was just things were priced for beyond perfection and, therefore they just needed a reason to have this kind of correction here. And I've also talked since then about the point you just made, Lance, which is that, I mean, you look at everything else that Powell did. He basically delivered on exactly what he said he was going to do. He spent an inordinate amount of time in his press conference telling us how incredibly strong, and I lost track of the times he used the word solid. That was his favorite word of the day. Everything was solid. GDP growth was solid. The jobs market was solid. He said, hey, look, inflation, sure, it's taking a little bit longer than we initially hoped to get to our 2% target, but we don't have any worries that it's not going to get there. And he basically said, and this reluctance to commit to more rate cuts going forward and be more data dependent, even though he always says they've been data dependent, he said that's a good sign. That means we think we don't necessarily need that many rate cuts to hit our target, right? And he said that from our perspective, things are going great, and our job is just to try to keep them going great, right? So, I mean, he short of wearing pom-poms, it would have been hard to have him be a bigger cheerleader. But of course, the market, reacted in the way that it did. So
But
to your
again, yeah, but again, Adam, though, my point is that was really just that portfolio rebalancing distributions, and that's
I
why you
get
saw
it, but whatever he said was the trigger to make all that happen,
yeah,
right?
yeah,
It
yeah,
was
right.
the
So, bonds got sold off, stocks got sold off, gold got sold off, Bitcoin got sold off, everything got sold off, right? It's just so everything you had to gain in, you had to sell, rebalance back to target, make those distributions. Everything at a loss, you took off the books for tax loss selling, took those losses in, and then you'll put those trades back on the books in 31 days. So yeah, that's all that happened, and the market needed it, right? And so if we're going to have a Santa Claus rally, and look, there's no guarantee you will. History says that about 73% of the time, or sorry, 76% of the time, you have a rally at the end of the year. But there is that 24% probability that you won't. And 2018 is a good example. And you'll remember this in 2018, the Fed was hiking rates. We're nowhere near the neutral rate in September. By December, the markets are down 20%, and magically the Fed's at their target, at their neutral rate, and they're not hiking rates anymore. So again, it's just, there is certainly risk that this market could sell off into year end. But with the markets deep, when we get to the technicals, we can look at the markets. The markets are very oversold now. You worked off a lot of that excess kind of exuberance in the short term. A lot of that negative breadth is now going to be in a position to start recovering. So you've actually got a very decent setup now, which is kind of what we talked about 2 weeks ago, is that, we're going to have that period of distribution that'll set the market up for that year-end rally, which will start on Tuesday of next week. The year-end rally starts basically the day before Christmas. So it may have started today, we'll see. But next week we have an options expiration day, so we could still have a little bit more volatility next week. But between Monday of next week and the end of the year, we should see this market rally. And interestingly enough, Adam, we're going to wind up right about my target of 6,000 by the end of the year.
Okay. Right. And it's funny, you mentioned earlier, a couple of shows that because we had been already over 6,000 and looked like maybe even on the way to 6,200 or whatever, and you said, look, that's totally possible. You gave us the reasons it could, but you said, hey, we're not changing our forecast. Not necessarily because you said, because we're definitely going to end at 6,000, but you didn't change your forecast and it might end up being on the nose.
Exactly.
All right. So, okay, here's where I'm trying to go though. So you said, would not surprise you if the Fed eventually has to change its tune throughout next year and end up cutting more than it's currently suggesting it may need to right now, right? So first question for you is, will that be interpreted? Do you think the market would continue to react bullishly to that, which is, oh, okay, we're finally getting rate cuts, happy days here again? Or would it be more like, as you've said, the economy is, I think your sense is the economy is more likely to slow than what Jerome Powell is currently projecting. And if he's having to do it because the economy is starting to slow, might the market start interpreting bad news as bad news, right? Like, oh, okay, maybe this is a reason to start discounting things a little bit.
Maybe. There's, I've got an article out today talking basically, we'll back up real quick. So last year, the way we came up with the 6,000 target was we did some analysis on the current earnings expectations of the markets versus expected valuations, right? And so we built out a analysis that used different valuation levels, saying, okay, if we have a year of multiple expansion based on these earnings estimates, then the market should be around 6,000, and that's how we got to that number. If we have a market that has a recession, then valuations are going to fall to this level, and because that's what happens during recessions, and based on current earnings, then the market would be at that level. And so that gave you a range of outcomes for the markets, gave you a high end and a low end. So depending on what happened, you could kind of navigate accordingly. So I just did that analysis. It's actually on our website right now. I just published it this morning at realinvestmentadvice.com. It's also on our Substack channel as well. But I ran that scenario based on expectations right now for earnings, which are $251 a share. So that gives you a range of about 7,200 next year down to about 5,500, depending on whether or not you get a recession. If you discount earnings, though, because the earnings estimates right now are well above growth trends. Our earnings grow on the long-term trend about 7.7%. So if earnings just revert back to where earnings growth is historically, which is what you should expect next year, is that earnings will grow, but it'll be slower than what's currently anticipated. That doesn't give you a lot of upside for next year. Actually, you have more downside risk in markets next year than you have upside. So so as we start talking about next year, so far, the markets have been interpreting every piece of bad news as good news because the Fed will cut rates. And I think that'll still be the case because there's still a lot of optimism, at least in the first half of the year, lots of optimism on, the Fed cutting rates and that we're going to have friendlier tax policies under the new administration and, potential, support for infrastructure, et cetera. But I do think that if the economy does weaken more than expected next year, now we're not talking about a recession, we're just talking about slowing down a bit. If the economy slows next year, which it should, and I'll explain to you why in a second, then I think earnings are going to be more challenged to meet $251 a share. I think we're going to see closer to 220 next year. And that's going to really make valuations much more difficult to maintain at these levels, which is going to press markets to trade more volatile next year and probably you're not going to have another 30% return year, like we saw this year. I think it'll be probably something closer to, 5 to 8% next year, maybe 10, would be a more realistic assumption.
Okay. So you're got an appropriate backdrop here, right? Lance says Grinch.
I like Grinch.
And I've been saying a lot, we've been talking about this too, right? It's like, most investors are going into this year like somebody whose team has won the Super Bowl twice in a row, right? All of a sudden you start thinking dynasty, three-peat. And even if your team just makes the playoffs, you're going to be super disappointed, even though otherwise that would have been a great year, right? So this could be a coming year where a single-digit return in the market that's historically normal is probably just not going to feel nearly as fun.
Right. It'll be a very like, wow, man, the market's only up 10%, this last year. That sucked. But honestly, that's what investors should expect. These years like we had this year and last year are certainly fun. I mean, it's been so easy to manage money over the last 2 years. All you did was just pretty much buy stuff and it went up. But again, there is the potential next year that we could have another very strong economic growth year. I mean, anything is possible. It depends on what happens policy wise. But I tell you, if we just did some analysis in our daily market commentary, I think on Tuesday or Wednesday of this week, Michael Leibowitz basically looked at economic growth rates for the Eurozone, China, UK, because the UK is not in the Eurozone, and Japan. And those economies are all near recessionary levels.
Mm-hmm.
They're growing, but just barely. And then we've got this 3.2% economic growth rolling off here in the US. And it's like, oh man, we're just killing it over here. And that's why we're just sucking in all these inflows. But that anomaly, that spread between economic growth in other countries and the US is not sustainable. Either all those other economic countries are going to have, all those other countries economically are going to have to start really starting to fire on all cylinders and starting to pick up growth to bring them up to economic growth in the US, or the US growth is going to slow down to catch up with them because we import deflation, we export inflation. That's because of how our economy works. So we're going to import their disinflationary pressures from their economy into the US over the course of the next year. And unless there's another massive stimulus bill or some type of other infrastructure spending bill, et cetera, the economy is going to slow. And that's just a function of economic drivers.
Yeah, and I was just going to ask that, right? Okay, so you present that as sort of an either or.
Yeah.
I don't get the sense, though, that you think it's a 50-50 probability set, looking out there into the world. I think you and I can come up with a lot longer list of reasons why we think the US economy could slow than a list of reasons why we think the rest of the world could suddenly, get back to strong growth.
Right. Well, I mean, you take a look at China. China is stimulating as fast as they can, and it's not really working this time around, for them economically. The UK is just, the UK's basically boxed themselves into a corner to create economic growth through kind of a lot of their previous policies. Germany and the most of Eurozone have made very bad economic choices over the last really 4 years in particular. In terms of energy supply and those type of things, which are just really starting to drag on their economy, and they're not deviating from that. They're still hanging on to this idea of, climate change and other stuff, even though it's destroying themselves economically. They're just going to keep going down that path. So there's nothing changing in their outlooks to start going back to the factors that drive economic activity, which is basically manufacturing, production, and supply. And they're not focusing on that.
Okay, I want to also come back to something you said earlier, Lance. So you said, look, everything sold off after the Fed press conference because it just needed the reason to do that. And one of the examples you mentioned was gold selling off. That, hey, if it was truly about inflation concerns, gold should have run off to the moon. I'm not entirely sure of that, because I asked this question the other day in response to this, which is, you can make an argument about, gold as an inflation hedge and it should do well if inflation concerns go up, no matter what the Fed had done, right? So if the Fed had cut, let's even say cut more aggressively, a lot of people would say, well, then gold would shoot the moon because the Fed is cutting because it's concerned about inflation. And when you cut rates, you're making the real rate, you're bringing it more towards negative. And that's really what gold responds to, right, is lower real rates, right? So the fact that the Fed is pausing, that means that the future reduction in real rates is going to be less than we thought, and therefore we got to sell gold off as a result, right?
Yeah, but and look, that's the argument, but gold has been detached from real rates for the last 2 years. So there's this big divergence between real rates and gold. And this is the problem with all the asset markets. We all have a thesis, right? So stocks are going to go up because this is my thesis, or the market's going to crash because of my thesis. Gold's going to do this because of my thesis. The problem is that these theses have all broken out from their normal correlations.
Yep. So all I'm saying is, I don't want to rat hole this. All I'm saying that was your statement that gold, if it had been, gold would have shot the moon. Well, maybe not for,
but my point,
that's a thesis too.
Right. But no, my point is that, and so if people think there's an inflation issue, right, a disinflation of the dollar, loss of purchasing power, the thesis is you buy gold. Well, in that environment, with what happened with the Fed meeting, gold should have at least held its own. Maybe it didn't go up, but it wouldn't have dropped 2.5%. My point is that everybody that owned gold this year had big gains in it. So if I'm long a portfolio, say for instance, we've got a portfolio that has gold in it, has bonds, has stocks, has all these other things. So now everything's completely out of balance. So I've got to go sell my gold to get those back down to my target weight balances, and I've got to go buy assets that have been underperforming to bring them up to target weight. That's what portfolio rebalancing is. So again, all we saw, my point of my statement is not trying to make an argument for or against gold. It's just we saw everything that had been big winners this year got sold off
Got sold
because
off.
that was that portfolio rebalancing that was going on.
That's fine. And I'm not trying to actually have a gold defense argument here with you here. Where I was trying to go with this is um, we saw probably much too early to tell and too much dust in the air, but we saw Bitcoin sell off a lot.
Mm-hmm.
And there's been a debate out there, and I think we've talked about it a bit on this channel, is what does Bitcoin really trade at? Does it trade at a mirror that reflects the devaluation of the dollar, or is it like one of the most correlated risk-on assets out there? And so when the
Yes.
market turns risk off, what's interesting is if you think it's because the market, I mean, it's risk off, the market just turned risk off. You could say, yeah, this is sort of showing that Bitcoin is a super speculative asset. Now, I wouldn't call gold risk on and gold sold off as well. So, like I said, there's a lot of dust in the air, but it is interesting. Had Bitcoin like shot the moon, um, then that would have said, oh, maybe it really is a anti-dollar move, right? But
Well,
so not enough to tell, but I just wanted to put it out there because I sense we'll keep talking
well,
about it going forward.
and the thing about it is that if you just take Bitcoin and do a correlation to stocks, it has a very, very high correlation to the stock market. And so pretty much when asset prices are going up and there's a risk on move, Bitcoin does very well. And look, if we ever get to the point of where stocks are down 20 or 30% because of the volatility ratio between Bitcoin and stocks, Bitcoin will be down 30, 40, 50%. It's more volatile on the way up and it's going to be more volatile on the way down. But there's a very, very high correlation between those two assets because they are just both risk on.
Okay. And again, I know a lot of Bitcoiners aren't going to necessarily agree with you on that. We'll probably hear from them in the comment
But they
section.
can do the correlation analysis for themselves. So
Yeah.
there you
But
go.
yeah, exactly. But we'll find out. Okay. So let me just note on the day we're talking, we got some updated data on the core PCE side of things. And just to remind folks, core PCE is it's a measurement of inflation. They strip out food and energy because they say those things are wicked volatile. So let's just try to look at the things that don't move as much. And the good news was it rose a little bit less than was expected. It rose 1/10% versus 0.2%, but it's still sticky at 2.8% year over year, right? And it comes into, it's consistent with what Powell was sort of saying, which is, this stuff's taking a bit longer than we would like. So I just want to note we now have recent data for core PCE, core CPI, and core PPI. Core PCE is 2.8, like I said, year over year. Core CPI is 3.3 year over year. Core PPI is 3.4% year over year. So I think the Fed is kind of running into the Pareto principle, right? Which is, 80-20. The first 80% takes 20% of the effort, and then the last 20% takes 80% of the effort, and that's what we're kind of here. I guess anything that you want to say about what's going on in inflation, because I know kind of like I put you kind of in Powell's camp, right, Lance, which is like, hey, given enough time here, inflation's coming down.
Well, I mean, look, everybody's all, I saw it was interesting, right? So, I had that debate with Michael Pinto, and he's like, inflation's going in the wrong direction. It's like, no, it's not. It's upticking a little bit here because we're now back to year over year comparisons, which are basically at the same level. So they're going to
The
kind
base
of
effect math, right?
yeah, yeah. It's just the base effect math, and we're going to see this little kind of gyration up and down a little bit as long as the economy is continuing to kick along at 2.8. We just got a GDP print for Q3 at 3.1. Q4 is going to be around 3% annualized. So as long as you're kicking along economic growth around that level, inflation is going to run right around that level because where does inflation come from? Inflation comes from economic activity. So if economic activity is at 3%, inflation is going to be, guess what? Close to 3%, somewhere around there, because it's supply and demand. That's all that's going on. And we don't have a supply chain problem anymore. And we don't really have a demand problem anymore. Consumers are doing okay. They're not doing fantastic by any stretch of the imagination, but they're able to tap credit cards, they're able to spend money. Retail sales data has been okay. If you take a look at the last retail sales report, you've really got to discount that one a little bit because retail sales came in a lot stronger than expected, but once you stripped out used cars, it was only up 0.2%, so it was actually a lot weaker than what was kind of really hoped for. But that big jump in used car sales was because of all the hurricanes that we had. So everybody had to go buy used cars because they lost
Right.
their cars in North Carolina and Florida due to the hurricanes. So not surprisingly, you saw an uptick in used car sales. That's going to fade out, and you're going to get back to probably retail sales growth of around 0.2%, which isn't great, but it's not recessionary, right? 0.2% will get you about 2.4% a year in retail sales growth, which is just on the borderline of slowing economic activity down. That's just enough to sustain economic activity. So if you do that, retail sales make up 40% of personal consumption expenditures, which are 70% of gross domestic product. So as long as you can maintain that over the next 18 months, you're going to keep printing out zero point 0.2, roughly 0.1, zero point 0.2, 0.3-ish, give or take on the month, in CPI, and CPI is going to start to drag lower towards that 2.5% mark by next year. If the economy slows down at all, if we get back to 2.5% growth or 2% growth next year, which is a decently high probability, then inflation is going to fall because, again, if inflation is at 2.7, economic growth is at 2, inflation is going to come towards 2. So it's just going to take longer for them to get there, but they're going to wind up in the same place.
Okay. I got two questions for you on this, kind of different angles. One, just looking for your personal thoughts on this.
Yeah.
So consumer spending hanging in there is what you're saying, right?
Yeah.
Not spectacular, but hanging in, right? And we've heard, lots and lots of stories about the increasing challenges that the consumer is facing. When you look out at consumer spending for the next year or two, are you more bullish or are you more bearish? You think like the consumer is more resilient than we've given them credit for, and you think they will continue to be, or is it more people are struggling, they're doing all the creative things they can to make the purchases that they're used to making, but they're kind of, burning their furniture to stay warm in the winter. Like eventually it runs out. Yeah.
Yeah, it's more the latter, but it's not bearish, right? As I said, you're going to see probably economic spending, consumer spending slow down next year, but it's not recessionary. It'll be on board. It will lead to slower economic growth, but it's not recessionary. So you're not going. In other words, what you need for a recession, if that's what you're looking for, is you need a contraction in that spending. And as long as employment growth stays in there, and again, you don't need fantastic. We don't need 300,000 jobs a month, but as long as you're not contracting employment to a large degree, and as long as you're not having some implication that's causing consumers to stop spending. Remember, consumer spending is very psychological. So as long as they're not threatened with their job, they're not threatened by some type of economic impact that makes them think they're going to lose their job, they'll keep spending. Because as long as there's kind of hope on the horizon that they're going to get up, go to work tomorrow and get a paycheck, they'll keep spending money because that's the way consumers are.
And
So,
a lender willing to lend to them, but yeah.
and lenders are willing to do that. So there's nothing right now that suggests the consumption side of the equation, which is the driver for the whole economy, is about to collapse. There's no data out there that supports that. I think there's more than a reasonable expectation because of all the stimulus money and all that was in the system that's now gone, that we're going to see slower rates of consumption next year, leading to slower rates of economic growth, which is why the Fed will come back and go from 2 cuts next year to probably 3 or 4 by the end of the year.
Okay. So let me ask the second question, which dovetails really nicely into that. So I was interviewing Jesse Felder just a few days ago, and he, Jesse, I sort of see he's a smart guy, but he's a smart guy who studies really smart guys. So he's a real student of the, Gunlocks and Buffetts and Druckenmillers. And I think it's Druckenmiller who basically said the best indicator he sees of the economy is like the inside stats on the economy and the markets. And one of the things that he really looks at closely is what corporate insiders, the people who know these companies best, are doing. And so he had these 2 charts I'm going to try to pull up here. Lance, do you see that one?
I do.
Okay. So this is correlation between um, uh, insider selling, insider sell buy ratio and the stock market. And basically what he says here is it's a good predictive correlation. But what he looks at really closely is this stat here, which is the correlation of the insider buy to sell ratio and corporate earnings. And these are time shifted. So basically, let's see here, the sell to buy ratio. Sorry, this is so small on my end. I gotta expand it
That's
here.
better. Yeah, I can see it better.
Oh, okay, good. So it's inverted and advanced 20 months here, but basically, yeah. So as insider selling goes, so go corporate earnings. So if insiders are starting to sell, then corporate earnings will follow within the next 12 to 18 months, right? And so you see
Wait,
here
wait,
the
wait.
red.
Hold a second, Adam, because if you go back to that, I just want to make sure I'm understanding what you're saying. I'm not arguing
Yeah.
with you. But go back to that first chart. What the first chart tells me is that insiders are terrible about buying the tops and selling the bottoms because basically they're all buying when markets are at their peak and then they're dumping their shares, kind of at the bottom. And so so he's saying that next chart is inverted, which means that when insiders are buying the most, that's when earnings are declining. And that would make sense because why do I do share buybacks? It's so that I can keep prices elevated long enough for me to get out of my options, even though the outlook for my earnings aren't that great. So that makes sense. I agree with that.
Okay. So I think I followed. Sorry, I was busy trying to get this other slide back up. And the way this is working is it's sort of fighting me. But
Yeah.
basically here, what this chart says is once the insider sell to buy ratio starts rising, and that's the inverted part here, right? So once this dotted red line starts going lower, the within the next 12 to 18 months, earnings are going to follow that same trajectory, meaning
That makes
earnings are going to start declining, right?
Right.
Which makes sense, right? The theory here is that the insiders know the company better than anybody else. And so they're going to sell their prices in advance of poorer results in the company, right?
Yeah. Okay, that makes sense.
Yeah. So, this is sort of leading him to say, I'm not sure that 2025 is going to be all that barn burner of a year earnings wise based upon that ratio, right?
No, and just X that ratio out. Um, and just forget that for a second. There's just a function that earnings are way, way too optimistic for next year. Hold on, I have a chart here.
And as you're pulling it up, the reason I'm bringing all this up is that could be a reason that would force the Fed to have to cut more, right? Which is, oh my God, corporate profits are coming in a lot worse than we thought. We're now worried about economic growth. We got to step in to be more accommodative.
Yeah, and that would not be surprising at all because again, when you kind of look. So first of all, this was also an argument by Michael Pinto that if we get into the next recession, bear market, the Fed's not going to step in because they don't want to create inflation. That's completely wrong. The Fed's job is to basically bail out the banks. Forget inflation. Our job is price stability and full employment. That is not their job in reality. That's their
Right, to keep the banks in business. Yeah.
They're going to keep the banks in business, and absolutely right. So, if we get into a real problem, we're going to be cutting rates drastically, very quickly, and a reversal of QT back to QE. But let me make sure I got the right image here. Oh yeah, okay. So this is earnings estimates over the last, so at the beginning of the previous year, S&P comes out with earnings that go through 2023 as an example, and then all the way through 2024. And the black line is what actually occurred, right? So what I've done is I've just, March 23, March 24, and then December 24. Now we're getting quarter four of 2025 estimates. So right now you can see that for quarter four of 2025, estimates are still at 251 a share. The long-term trend, though, is that black dashed line, which is about 7% growth. So yeah, there's a really high potential. And again, earnings always trend along that growth. They got a little bit elevated in quarter one of 2022. Why? Because we were like just jacking the economy full of liquidity, remember, in 2021. And so everybody's very optimistic about 2022, right? And then what happened in 2022? The market declined 20% and earnings fell back to the trend line. And then over the last really 23 and through 24, we just slowly been kind of grinding right along that trend line of growth. As a good example, at the end of 2023, analysts thought that earnings for 2024 would grow at 15%. They turned out at 9. Next year, they're expecting 19% growth. Reality is they're probably going to grow about 9. And so we're going to be right towards that kind of that trend line of growth in earnings. And so if that happens, to your point, and this is to Jesse Felder's point, what the markets are looking at next year is extremely optimistic. And even though you'll still have a positive year, you're going to get to about $220 a share in earnings versus 251. So if the price of the market doesn't move, we're going to be talking about 30 times earnings. So it's valuations are going to have to be repriced by the markets, which you should expect a slower rate of growth next year and really a lot more volatility. So, next year, as an example, we could start out gangbusters next year because there's a lot of momentum and positive sentiment in the market, new administration. We have a big rally in the first 6 months of the year. So we get into May, June, and we have a 25% correction next summer. And then we have a rally at the end of the year and pretty much wind up to the end of the year about where we started at the beginning of the year. And everybody goes, well, what happened? Right? But earnings will have realigned themselves to the trend in that type of environment.
So a couple questions on that. So let's say that earnings just follow the trend line out to the end of 2024, right? Or 2025. Why is the market going to care about that? Because it has not cared about that since Q4 of 2022, right?
That's right.
We have the market, the earnings have totally underperformed where the expectations were, and yet stocks haven't cared. They just kept going higher, right? They kept expanding the multiple. So first question is, why wouldn't the multiple just keep expanding?
Well, it can. So as long as so what we've had over the last 2 years is what's called a multiple expansion bull market. The only thing that's gone up is the valuation, the multiple, not the earnings, right? So earnings have risen a little bit, but primarily a huge chunk of the move has just been people willing to pay more on the expectation that earnings are going to come to fruition at some point down the road. Again, as a good example, just to explain this. So look at that dashed blue line, right, in this chart. So that was the estimate for the end of 2024, originally back in March of 2023. So in March of 2023, analysts said in December of 2024, we're going to be at $227 in earnings. We don't have quarter four year, end of year yet. So as of quarter three of this year, earnings are only $200 a share. They're $27 short of what analysts said. So last year, everybody was buying stocks on this huge expectation that earnings were going to catch up with the reality. So they drove multiples higher. Well, the expectation then is, well, next year they're going to be 251. So we're going to go from 265 to 251. We're going to have a $50 increase in earnings by the end of next year. And that's what everybody's buying stocks on. The reality is that's not going to happen. But since we're always promoting these forward operating earnings, which are earnings without all the bullshit, the stuff that really happens, like expenses and payroll and those type of things, investors are willing to pay that. That's just psychology and sentiment. That's all that is. When reality hits at some point, then that's where markets are going to have a bit more trouble because you're going to have to reprice markets for reality versus fantasy.
Okay. And look, what you just said there is the number one concern on the mind of all the viewers of this channel,
Sure.
right? Which is they know the market's been increasingly pricing in the sizzle, not the steak, right?
Correct.
And they're worried that at some point it's going to have a wake up moment. And my question to you is just, what do you think would cause the market to do that next year because it hasn't done it the past couple of years? Is there a particular development or event, or is it just going to be disappointing GDP growth numbers or whatever?
No. So, And so your question that you asked was the right question a second ago, which is that hasn't mattered for the last couple of years. And as long as there's no event that comes along, remember the markets are driven by sentiment. And so as long as there's nothing that is changing, there's nothing impairing that outlook that earnings are going to keep growing, AI is going to keep doing their thing, Bitcoin's going to go to 1 million, gold's going to go to 5,000, because it just depends on what market you're trading, right? Everybody's got a very bullish thesis right now. So as long as that bullish thesis remains intact, well, if reality doesn't come true this quarter, well, it'll come true next quarter, right? And then next quarter doesn't, yeah, well, it's okay, it didn't come reality this quarter, right? The dollar's going to fall apart and that's going to cause gold to go to the moon, right? That's my bullish thesis. Well, the dollar's rallied like a banshee lately, but next quarter it's going to fall apart, right? So as long as there's nothing that disrupts that view, whether it's, earnings are going to go to the moon, Bitcoin's going to go to 1 million, the dollar's going to collapse, whatever your thesis is, as long as nothing disrupts that thesis, investors are willing to pay up, right? That sentiment, that bullish sentiment for whatever asset class it is, they'll keep buying it. What you have to have is something that comes along that all of a sudden kind of smacks people upside the head, and all of a sudden, all those expectations over the next quarter or 2 or 3 are now gone. And now I was like, oh, I did not expect that. And that's kind of what you saw on Wednesday when the Fed came out and adjusted this dot plot. All of a sudden, investors, wait a minute, hold on a second. That wasn't in my playbook. So in order to have a big mean reverting event, right? So if your listeners are out there looking for a 20 or 30 or 40% decline in the market, you've got to have some event that comes along that occurs overnight, literally. It can't be something that everybody knows about, like valuations. Valuations are elevated. That does not cause a market to
hasn't mattered forever. Yeah,
exactly. Because the markets can see it, they can price it in. So it's got to be something that the market is not even anticipating. Tomorrow morning, this news headline hits, and all of a sudden markets go, I can't price that. And all of a sudden, they've got to get out.
Can I ask a question about that? Because we've talked about this before. It needs to be a Lehman movement. It needs to be the bullet that nobody saw coming, right? Because if you could see it coming, it would already be priced in to a certain extent. Right. Totally get all that. Let me ask you this. Does it have to be that? Or, we do have data from other price bubbles where there isn't an event. It's just the magic moment of supply and demand where somehow we got to the point where the net buyer shifted from net bullish to net bearish. We just sucked in all the potential bulls, right? And you think of the tulip bubble or the South Sea bubble or whatever, right? It wasn't an event that caused it to reverse and peak. It literally just got the last of the buyers in it was going to get, and then it shifted. So could it be that as well, which is an unknowable as well, right? Nobody knows when that price is. We just hit it.
So, but remember, and to your point, look, generally it takes an event of some sort. And again, we're not talking about a Lehman moment where you have a complete financial crisis, right? I'm not saying that at all, right?
No, but it's the thing that nobody expected to read in the papers that morning.
Correct. Like right now, everybody's focused on the government shutdown. Everybody knows about it already. The market knows about it. So that's not going to be the event. But let's say a month from now, there's a major power disruption. I'm just making stuff up, but there's a major power disruption that wipes out half of the United States, right? The whole electric grid goes down.
There's a solar flare. It's an EMP. Yeah,
there you go. These plasma balls that are flying around New Jersey turn out to be real aliens, and they all land. It's got to be some event like that all of a sudden changes the dynamic where investors say, earnings are not going to grow in this environment at the rate I thought they were, and it's going to change. Because again, that's all about psychology. So again, I've got everybody buying right now. So again, we've had this conversation before, but what makes prices go up? I've got limited sellers and a large number of buyers. So in order to get somebody to sell something, the price has to come up to the point that the seller's willing to sell it. And that's why the prices go up. Well, at some point, the buyer's out there going, I'll pay more. And the seller goes, okay, great, I'll bring it up. And at some point, there's no buyers there. For whatever reason, the buyers say, I'm not willing to pay any more for that asset than this price. And nobody's willing to buy up. And so a seller steps up and he says, okay, I'll sell it for a little bit lower. and the buyer says, okay, I'll take that. And all of a sudden, everybody has to start selling to find a buyer. And when that table reverses between supply and demand of buyers and sellers to a supply excess of sellers over buyers, that's how you get these very sharp reversions. Because as we've talked about before, buyers live lower, sellers live higher. And you've seen this before where the markets will open down 2 or 3%. And that's because that's where the buyers are. The buyers are 3% lower than they were yesterday because that's where they're willing to buy today. So what causes that, you never know. It's all about sentiment. And you got to have something that changes sentiment literally overnight.
Well, and I'm just wondering, so I agree with all that. I'm just wondering, could the sentiment change itself become a self-fulfilling prophecy without a solar flare or aliens or whatever? In other words, we're like, the market just says, man, I'm showing up, in the market, but people are just the sellers are just, or the buyers are just coming in lower. And then as time goes on, people just begin to realize that like, oh, wait a minute, this thing's got downward momentum. I don't want to be caught being the one here. Yeah. And eventually it just kind of becomes its own, it doesn't necessarily have to be an overnight sell. Maybe it's a long grind down, more like a 2022, but people just begin realizing that the tenor of the market's changed. They don't know why. We might have just hit that magic, tipping point, but they begin to realize, whoa, the things are different.
Right. Well, 2022 is a good example, right? We went into the end of 2021, kind of hair on fire in terms of buying everything. And then Russia invaded Ukraine. Another good example is 2019. 2019, the markets are melting up higher. We're doing great. Everything is fine. And then in March, everything goes because of a pandemic. When we go back in history, it's always about the shift in sentiment. We'll find, and when that shift in sentiment occurs, and look, that's all it is. It's just a shift between buyers and sellers, and we'll assign some rationale to it. Well, the reason this occurred was because of whatever is occurring at that moment in time. But it's always simply just a function of where buyers just say, I'm tapped out, I'm not buying anymore at this level.
Right. And I think we're largely agreeing here, and I've often said it's sentiment. You could have something to cause the sentiment shift. But again, one last analogy. Could it just be like Beanie Babies, where eventually people just woke up and said, you know what, I'm just not paying anymore for this stuffed animal, right? And it's not that there was a fire at the Beanie Baby factory or that Beanie Babies were found to cause cancer. They just said, look, it's overpriced and I'm not paying anymore.
Well, no, and I'm agreeing with you. What I'm saying is that the media will assign a reason to why.
I totally agree.
Why did the buyers stop buying here? Oh, well, this happened over here, and that's the reason. I gave you my example previously about IBM. IBM, this was at the dot-com crash, and as we were going, and IBM was down in the morning rather sharply because they laid off 5,000 employees. By the afternoon, the IBM was up sharply because they laid off 5,000 employees.
Right.
We just have to, as humans, we just have to assign a rationale to actions. So when the event occurs, whether it's next year or 5 years from now, whenever it occurs, we'll all be sitting around talking about the reason why.
Yeah.
Right?
Okay. That's what I was going to add on to this. Okay. So you said, you mentioned the drama that we're having in Congress right now. I think you think it's probably, do you want to talk about that first?
Sure. Yeah. This has been a week of good stuff. So we had the Fed meeting on Wednesday, and then really Thursday and Friday was all about, and actually kind of this started on Wednesday. Part of that sell-off on Wednesday was not just Fed. It was also this debt ceiling issue that's coming up, and we have to get this spending bill passed by Friday or the government shuts down. Not surprisingly, I'm already getting a ton of emails going, oh my God, if we shut down the government, we're going to default on our debt. Absolutely not true. The only thing that a government shutdown affects is about 2% of government spending. And this is why historically, when we've actually shut down the government, we lay off 900,000 non-essential workers for a post-paid holiday because they get all their money back when they come back to work. And we shut down parks, national parks and monuments, because the debt gets paid, Social Security, Medicare, Medicaid gets paid, military salaries get paid, interest on the debt gets paid. All that gets paid. That's mandatory spending. It gets paid no matter what, whether the government's operating or not, doesn't matter. So, that all those things you're going to see in the headlines, and you'll see a lot of this on CNN and the news channels going, well, if the Republicans don't cave and pass a bill, we're going to default on our debt. Absolutely not true by any stretch of the imagination. Interest on the debt will be paid. because the interest expense on the debt is only about 2.8% right now. So we've got a very low interest expense ratio on our national debt. So it's very manageable.
All right, Lance, I just got to pull on that last comment you made because I'm guessing it was a scratchy record moment for some people. You just said, "Oh, our national debt's super serviceable." People are gonna be
Yeah.
like, "Wait, Lance, wait a minute. We've been talking for the past year about how the service cost on the national debt has exploded, and we're now paying over $1 trillion a year. What do you mean? It's totally affordable?"
Well, if you take a look at the interest rate on our debt, yeah, and again, just look at the interest payments that we pay out as a function of the total national debt, right? The $35 trillion dollars. It's our interest rate on that is about 2.8%. So if I could finance a $35 trillion, say a $30 trillion economy at 2.8%, why wouldn't I? That's cheap money. So, this whole notion that, and again, you take a look at interest expenses as percent of our total budget. Yes, it's certainly gone up. We've got total debt to GDP right now running about 118%. That's completely financeable, right? And we can run that. So we can run that for a long time. We talk about Japan and those type of countries are running 230% of debt to GDP. They're still operating now. That's not great, right? It's not, we're not going bankrupt as a country by any stretch of the imagination. But once you're running 115, 120% of debt to GDP, you're going to have slower economic growth. That's just a function of what comes out of that. But in terms of our spending and maintaining our budgets and those type of things at 2.8%, that's fairly cheap financing for the government.
Okay. All right. So your comment was more of a relative one.
Yeah. But you're going to get slower economic growth out of it. That's why we're going to grow at 2%, right? Which is the Fed's long-term projection anyway, because the more debt you have, the slower economic growth you have. But that's also why you can't have 1970s inflation either, because of the debt, right? You can't afford interest rates to be 6 or 7%. You can't. What you can't afford is to have that 2.8% financing rate to go to 5, right? That can't happen because now you've got a real problem. But at 2.8%, you're still okay, which is some of the lowest levels of financing we've had on the debt in history anyway.
Okay. And just to connect dots for folks, because of that debt, that's why you think the economy is going to slow, down to more 2% growth. That's why you think inflation will come down. That's why you continue to be in your bond position.
Yeah.
So I actually thought, Lance, you were going to talk about the Houston conference because that's what was up on the screen while you were talking there. So I've got a question here about the government shutdown thing, but since you just showed it to people, and maybe the folks listening on the podcast didn't see it, but why don't you talk about it real quickly, just so folks know what to expect and interested folks can maybe come join us.
Yeah, absolutely. No,
Pull it back up if you can.
yeah, I am. So we're really excited. If you go to our website right now, realinvestmentadvice.com, we are having a conference with Adam this year, just like we did last year. So we're going to do this again, but we're going to be talking about the outlook for 2020. Michael Leibowitz is going to go all through the credit markets, everything looking at credit wise in terms of what it will look like next year. Talk about the Fed. Adam will be there to help us out as well and cover a variety of his topics. So it's going to be a great event. Right now we've got an early bird special of $99. That price will go up to $149. We do have a block of rooms set aside at the hotel. So if you want to fly in to come see us, we'd love to have you. We've got a discounted rate on the hotel rooms as well. So just if you go to the website, you can register there. If you've got any questions, simply click the ask a question button and say, hey, tell me more about it. What can I do? When's it going to be? All those type of things. And we're happy to help you out.
Great. Can I just make a comment or two about the event? So we did this last year. It was a lot of fun for me, but I thought it was a great event, and I think people who went last year can chime into the comments, so you can listen to them, but not me. But I only heard nothing but great feedback from it. But what's so fun about these events is you get if you like Lance Roberts, if you like Mike Leibowitz, and to be honest, how can you not like those guys? You get like full throttle access to them. Lance goes through a ridiculous amount of charts, no big surprise. For those of you that keep asking week after week after week, hey, the RIA guys changing their minds at all about their bond trade, you will get any and all of those questions answered when you're there. Plus the ability to talk to Michael and Lance, yourself personally, in the hallways there to get, whatever questions you have around that answered. But in addition to just going there and hanging out with us and listening to what we have to say, I think the huge value that the attendees get, and I know this from having done my events in the past, but I certainly saw this at yours last year, Lance. It's the benefit of being in the room with other like-minded people like themselves, where a lot of this kind of wonky macro stuff that we like to talk about, it's not necessarily cocktail party conversation. And so, there are a lot of people there who are like, I want to talk to my spouse about this, or my neighbors or my buddies, and they really don't want to engage with me on this, right? And so to be in a room where it's what everybody wants to engage in, and they're smart people, and you can bounce lots of ideas off of each other, that's definitely a big part of the magic that happens here. And I also think another thing that was really good that we did last year that I'd encourage maybe think about doing more this year, Lance, is so it's not just you and Michael and me, it's your whole team there, right? So I assume you're going to have Richard and Danny and those folks there. So they come up on stage as well. So it's a pretty big brain trust. And at some point in the day, we just start taking live questions from the audience. And that's really where things get really interesting. And you can kind of see it in the audience where people are a little reticent to ask their questions, but some brave soul does. And very quickly, it dawns on people that like, oh, I can ask anything of these guys. And then the discussion just kind of goes crazy. But we really get to roll up our sleeves and dig into the things that the audience cares the most about. And you've got some macro and markets guys to give their points of view, but then you have the personal finance guys there, the financial planners, who can get like really laser specific about, okay, you've got this specific issue with your retirement account or what you're trying to do with your children, or this issue that you're facing, trying to decide whether to sell your house or whatever. And chances are, if somebody's asking that question, like at least 12 to 20 other people in the audience have the same question as well. So it really becomes this just very dynamic forum. So anyways, if that sounds of interest to you, then come to this thing and join us. I just want to make it clear, you're not sitting back in a chair all day just listening to people drone at you. There's a lot of really exciting interactivity that goes on.
Yeah, exactly. And we spend a lot of time after the conference just visiting with people one-on-one. So, and we're going to do that again this year. And as you said, we're going to have a live Q&A panel. It'll be you, myself, Mike, Danny, Richard, just answering questions. So to your point, and those are always the most fun because you get some of the most off-the-wall questions. And it's kind of like, hey, let's try to trip up the panel, right? So these questions come out of left field, and it's a lot of fun. I really enjoy doing these. They are a lot of fun. They are very educational. And again, we really spend a lot of time putting together the presentations. I'm working on one for outlooks for all of next year, going through everything from valuations to tax rates to just about everything you can imagine, to really kind of gauge what the risks are for next year and how we're going to navigate that market wise.
All right, and just to put a bow on this. These are super useful to me because I don't do too many in-person events during the year. I'm just too busy with all the virtual recording and stuff. And so this is one of my few opportunities to really hear directly from real people what they value about what we're doing here at Thoughtful Money, but more specifically, who they'd like to see on the channel that I haven't gotten yet, topics they'd like to see covered that I haven't yet, different types of content formats and stuff. So very, very useful to me. So if you do come and you have feedback like that, please let me know. Also, just to set expectations, come early to the event if you want to hang out with me. I'm going to hang out as much as I can near the end, but Lance, I've got, sadly, the Vancouver Resource Investment Conference is the next day. So I've got to find some way to get from Houston to Vancouver after this thing ends. And then I just got jury duty summons right in the middle. So I actually have to figure, fortunately it's 2 days after your conference, but I got to figure out if there's a way for me to push that off a little bit so I can come back from Vancouver and still meet my obligations, or I might not even be able to go to Vancouver. So there's a lot going on there. All right, so go ahead.
I've got to fly to British Columbia in February, and I tell you what, getting from Houston to Canada, period, that's a trick.
Don't tell me that.
Yeah, no, and it's funny because I booked my flight, so I have to fly from Houston to LA to British Columbia. And they've changed my flight now 6 times since November, moving my times around.
Right.
So I really have no idea if I'm going to get to Vancouver or not. We're going to see. But I'm going up there for the Bunny Talks conference to do a presentation, and it's going to be interesting to see if I can get there or not.
Oh, well, good luck. I know when I went to Vancouver, the same conference last year, it had been like a nightmare. Fortunately, it was easy for me to come from Northern California to it, but I mean, Danielle DiMartino Booth, several other people just had horror stories of like flights being canceled and having to like, sleep on the, airport, chairs, and stuff like that. I know Matt Peipenberg, who was coming over for it from Europe. Yeah, they sent him to like, I don't know, like 3 or 4 different cities before they finally got him in like 2 days late. It was crazy. But anyways, let me get back to what I was looking to ask you about. So yes, I don't think you think that the drama that's going on right now over this continuing resolution is all that meaningful, and certainly don't think you think it's anything that's going to really impact the market sentiment, we'll say.
Right.
But let me ask you this. Here's a reason in which it might impact the market sentiment. A lot of what's been animating the animal spirits in the markets over the past month plus has been excitement over Trump, right?
Right.
And right now, it's all been about promise, right? It's all been about all the great things I'm going to do when I'm in the office, right? And the Doge guys, it's amazing to see what Elon and Vivek are already doing just through their social media channels to garner support for everything, right? And we had this really interesting showdown just happened over the past 48 hours, right? Where the bipartisan deal was struck. It was 15,000 pages or whatever. And Trump and Elon and Vivek basically said, this is terrible. And they put a ton of pressure on Republican Congress people to say, go back, get this thing trimmed down. To their credit, they came back with, and you've seen probably the pictures on social media where you have the 15,000 page stack and then the 115 page one that then ensued. But that one got shot down yesterday, right? Yeah. And so, yeah, I mean, I don't think anyone's super really worried at a high level about the impacts of government shutdown. But could this make the market begin to wake up and say, you know what, it's not going to all be sunshine and roses for Trump. He's not going to be able to come in and just steamroll everything that he wants to do there. And maybe we get to start pricing, walking back some of these grandiose expectations that we might have been developing that like, oh, he's going to change everything on a dime from day one.
Yeah, I think that's one of the reasons why earnings aren't going to be at 251 a share next year, right? I think that's why you're going to see earnings decline to probably 220-ish, somewhere around there. It's this, there's a lot of hope that he's just going to come in and just, we're going to do this and we're going to do that. Or this other thing is still all just going to be sunshines and rainbows. It's not. He's still dealing with a government machine. And, if you take a look, so that the bill was 1,547 pages, and it had nothing to do with actually just extending the spending. So if you don't understand, and we've talked about this on the show before, we don't have a budget. We have not passed a budget since Obama took office in 2008. We've been funding the government on what's called continuing resolutions. And a continuing resolution, all it is, it needs to be one sheet of paper. It says, this was last year's spending. We add 8% to it. This is this year's spending level, right? That's all it is. That's why the last continuing resolution, I think, was 28 pages, something like that. It was very lean. All the other stuff is all these government wish lists, right? Dog-eared projects. I want this. I want some farm bill funding. I want some more aid to go to hurricane relief. I want more money going over to Ukraine. I'm making stuff up, but more money to go over to Ukraine. I want a government pay raise. I want everybody in government to, everybody in Congress gets a pay raise. That has nothing to do with the continuing resolution. Those are separate spending bills. If you want to do that, then you go pass a bill to give Congress.
Separate bill, yeah.
Right? And this is why we have the spending problem we have, is because A, we don't run a budget, and B, prior to World War I, every spending item had to be passed by Congress. And it could only be one item. So if you wanted to fund farmers, that was a bill. If you then wanted to fund Ukraine, that was a bill. Well, going into World War I, they had to figure out how to get a whole bunch of spending done very quickly. So they started doing these bulk bills where they would just pass a whole bunch of stuff at one time. And the problem is that, like with my kids, When my kids became fairly fiscal, kind of, fiscally irresponsible, I took away their debit card and I said, nope, you're back to spending cash until you can figure out how to budget yourself. And you go back to just doling it out. You have $20 this week, you go figure it out, right? You have $20 this week, you'll figure it out. Well, once they got their financial sensibility put back in line, I'll let them go have their debit cards back for their, and this is their own money, by the way, because they earn it, they work for it. I just took away their debit card, made them go get cash. I just made it very difficult for them so they could learn the lesson. And that's what we need to get back to with government. Look, it's very onerous to pass a bill, one bill per spending item, but until you can learn to be fiscally responsible with taxpayer money, that's what you need to go back to doing, right? But that's not how we run government. So it's kind of a wish list. But that whole bill was nothing but pork spending, and so it was great that Elon and Trump pressured Republicans to pass on that first bill. That would have been a terrible spending bill. And now it's going to be interesting to see what they actually come to. If I was Trump, right, I would hold my ground, let the government shut down for however long it takes until they cave and they pass just a clean continuing resolution that says, here you go, here's 8% more, you're in business. And then that would also be my last continuing resolution, because everything from here would have to be under a budget.
Well, hopefully you get elected to his Council of Economic Officials and he listens to that. I think, from what I can tell, and I'm no political analyst, but I think he is happy to let this thing go to a shutdown just as long as it happens before he gets into office. So it happens on the current administration's watch, not his. Let me just ask my question one last time, which is how could this contribute to a shift in sentiment, which is, again, like I said, up until this week, it was Trump's coming in and he's going to run the show the way he wants to. Now, today, it might be, oh, wait a minute. No, maybe he might not be able to. Maybe the swamp gridlock is going to hinder him more than we thought. Might that create sort of a downshift of expectations?
Maybe, but historically, here, I'm going to show you a table. I was just doing this for this weekend's newsletter. I haven't quite finished all this up, but can you see this table?
I can, yep.
Let me see if I can make it a little bigger for you.
That's better, yeah.
So this is every government shutdown in history going back to 1976. So the average length in days of shutdown is about 8 days. The average return in the S&P is about 15% positive. So 0.15%.
Is this a return during the shutdown, like during those 10 days in 1976, the S&P declined 3.42? Okay.
Yeah, exactly. So during that, so that's kind of, how it's worked out over time. So yes, you could have a little bit of a pullback here. That wouldn't be surprising. The last shutdown we had was in 2019 and we were up 10% during that shutdown for 35 days. So, it really doesn't affect markets a whole lot. It does introduce some volatility, but in reality is everybody knows that the shutdown is temporary and that there is no risk of default. If there was a risk of default, markets would be down 20%, right? Sure. If people are true, and remember back in 2011, we were on the verge of shutting down the economy, and that's just, we have those kind of debates that we go through, and it's certainly disturbing, but the reality is the market kind of sees through it pretty quick and realizes it for what it is. It's more theatrics than anything else. Everybody knows that at some point at the end of the day, we're going to, resolve the issue and we're going to move on down the road.
Okay. All right. Well, look, I want to get to the S&P charts just to show folks where we are on the technicals. I want to get to your trades. I also want to just very quickly see if there's anything else from the debate with Pinto that you think is worth talking about. Then I have a small rant, which is really more like a holiday wish for folks, and then we'll wrap things up here. So,
like we have a rant that's a wish.
Yeah, well. Okay, so yeah, all right. The technicals are starting to look pretty different than the way they've looked the past couple of weeks. So tell us what they're saying.
Well, no, I mean, this is, pretty much it's kind of what we were talking about, 2 weeks ago. We said, hey, look, we're getting into this, we've had a very, very good year. We're going to get into this distribution phase. And as we talked about last week in particular, is that if you're a 60-40 allocation model and you're just buy and hold for the year, because of the rally in the S&P, you're 65% stocks and 35% bonds. So you've got to flip those around and rebalance your portfolio. And so again, as I said earlier, a lot of managers just like us were just hanging out, kind of waiting for that Fed meeting to see what was going to happen. So a lot of that sell-off that you saw on Wednesday was just the last phase of those tax loss selling and rebalancing of portfolios. And so on Friday, we're back above the 50-day moving average. So again, we had a little quick break of the 50-day. And as we talked about before, one of the mistakes that investors make is you break a moving average and they immediately knee-jerk reaction go sell stuff. Like, oh my gosh, we broke the 50-day, I got to sell. You've always got to be a little bit careful because you can get whipsawed in that, because by the time you get to that level, you're already fairly oversold. And that's kind of what happened. So on Friday, saw a very, very good rally. Markets are doing decently on Friday. It's still early, in the morning on Friday as we're discussing this here. But
right, they're up the S&P is up about 2% right now. Yeah.
Yep. And so again, where we finished today, I don't know, but likely we're going to finish above the 50-day moving average. Markets are decently oversold on multiple levels, which is really kind of just setting the market up for this end of the year rally that could push us back up to 6,000, 6,050, somewhere in there to finish out the year. We'll see.
Okay,
again, and nothing technically wrong with the market at all right now.
Okay, that little blue arrow up on top, that was a sell signal triggered, correct?
Correct. And we talked about that. We said, hey, we're getting a sell signal, which will limit your upside in the market as long as that exists. And sell signals are generally pretty good about, indicating potential downturns in markets. So it's doing its job of, it warned us, to not take on additional risk, not chase the market. We rebalanced our portfolios just, kind of around the edges, those type of things previously. So again, we're just, kind of in a good position now. And now that the markets are kind of getting oversold, we're now getting set up for that kind of year-end push. And so yesterday, we added to our energy exposure. We had reduced our energy exposure back in August because of concerns over oil prices, economic growth, those type of things. And oil prices have dropped, fairly decently. We're down to around $70 a barrel as of yesterday. And energy stocks have got completely crushed during that process. So there was a big risk-off rotation in the energy sector over the last 2 months. And so we took our energy stocks back up to target weights yesterday. So we bought ExxonMobil, we bought Diamondback Drilling in the ETF model. We added to XLE and brought those back up to weight because they're deeply, deeply oversold here. And we should get a relative performance pickup in those stocks going into early next year, just on a rotational kind of rebalancing basis.
Okay, great. So we're already into trades. Is that the only trade that you made since last week?
So far, we're probably going to we'll see kind of what happens after today. Next week, we may add a little bit more, particularly to areas like healthcare. One of the stocks I was going to add to is up 10% today, which was Eli Lilly, but we're already pretty much fully weighted in that position. But there, some of the areas of the market, if you take a look at what this, really kind of the rally's been lately, it's been discretionary. And we had talked about this back in, I think, late October. You and I discussed that going into the end of the year, that mega caps would lead the way. And that was because of stock buybacks and those type of things. So pretty much since then, what's been driving the market has been technology, discretionary, and communications, which are all your mega caps, right? That's Meta, Google, Amazon, NVIDIA, et cetera. Those stocks have been doing pretty well. And so as that's been kind of really driving the market, healthcare, energy, other sectors of the markets, industrials, basic materials have been under a lot of pressure. Those stocks are pretty deeply oversold now. So we're kind of probably go through and do a little bit of nicking and, kind of picking and nipping here and there, just trying to pick up some distressed values. And
little bargain hunting?
Yeah.
Okay. All right. And then to just your overall point about year-end, Santa Claus rally, if you will. Next week is, if we're going to have one, when it's going to show up, right?
Right. It'll show up between 2 days before Christmas and the first 3 days after the beginning of January. That's typically where it occurs.
All right. So technically, this is the second trading day before Christmas.
Mhm.
Santa could be showing up today with this big green candle, right?
Right.
This could be the start of it.
This could be, it might not be. We'll
Yep.
see.
Well, obviously, we'll find out. But
Yeah. And again, that's the key thing. Like, as I said at the, kind of the outset of the show is that, 76% of the time you get a rally into the end of the year. But there is not not so significant point of 24% of the time it doesn't happen. So I think you just have to kind of trade it accordingly and just manage your risk.
what was that line from Anchorman with Paul Rudd with his like, I can't remember. It was like his uh, Jaguar sweat cologne or whatever. It was like 60% of the time, it works 100% of the time.
Exactly. It's all about statistics.
All right. Well, here, as we start to wrap up here, you mentioned a couple of times your zero hedge debate with Michael Pinto. Anything else about that we didn't talk about? Was it as I expected, Lance, that you guys actually probably had a lot more to agree on than you had to disagree on?
Yeah, it was funny because, we were supposed to debate this whole idea of a 50% decline in the market. And we actually never really talked about that much. It was off on, talking about debt and inflation and Fed policy and just about everything else under the sun. But no, again, I don't disagree with his view. My point with him was it's great that you've got this view that investors are going to lose 50% of their wealth. When? Tell me when it's going to happen so I can manage for that. But the problem is that we never know when it's going to happen. So this is always the problem with predicting crashes and downturns. They happen very rarely. When they do happen, they're certainly consequential. But if I'm out of the market for 6 years waiting for something to happen and the market goes up 100%, we're up 50% in 2 years in the markets, right?
Right.
So 2 years ago, I was waiting for the big one to come along. I've lost 50% return in the markets. And here's kind of the interesting thing. If we have a 50% crash from where we are right now, we're only back to where we were in 2019, right? We wipe out.
And the bull channel trend is still intact at that level, right?
You're still on track. So you don't even correct the bull trend. Now you want to talk about 80% correction. That's a different story. But, we're very deviated from long-term means. We're overbought on an exponential basis on a variety of levels on long-term basis. So if you look at monthly, quarterly charts, extremely overbought. We are going to have a correction of some magnitude at some point in the future. That I can 100% guarantee you. The problem is I can't tell you when. And so if
it's 10 years away, it doesn't help you to go to cash now. Yeah.
Right. Yeah. So if you go to cash today, it could be 3 years and another 50% higher from here. And then you correct and you're right back to where you are today. And you just kind of wasted 3 years of your life. Right. So, the problem with predictions is that they have to be timely and they have to have some time frame to them so you can determine whether or not the call was right or wrong. And that's why I always keep things with you very short, saying over the next 2 weeks, Adam, we're going to have a correction because of portfolio rebalancing. Then we're going to have the Santa Claus rally. Beyond that, I have no idea because market technicals and statistics tell me that's about what's going to happen. After that, it's just a complete guess.
Well, and one thing I want to give both you and Michael credit for is, you guys manage capital for real people, right? So you're not just slinging opinions out there. You have to make allocation decisions based upon your estimations. And I think both you and Michael, I mean, honestly, I talk to you guys a lot. I think you're in many ways, very, very similar, where you both think the market could correct by 50%. You think that should happen, right? Like that would bring it to a fairer value. But you got to shepherd your client capital to the best outcome that you think it can. And Michael the words Michael will use is he'll say, well, look, I don't know when the crash is going to happen, but my 20-point model is going to tell me when we start entering these different phases, and that's when I'm going to be allocating. You would laugh and say, well, my 21-point model says that.
I actually used that line to him. I said, well, Michael, I have a 21-point model. So I did promise Michael that you would have me and Michael on your show so we could display our 20 and 21-point models.
Okay. I love it. But you essentially say the same thing. You don't necessarily have so a fixed number of inputs for your model, but every week you come on and say all the things we look at lead us to believe X, Y, or Z is going to happen soon, and then after that we'll take it from there. So neither of you says, "Oh, I think by Q2 of next year we're going to have a X% market correction," which I will put in contrast to a guy like Felix Zulauf, who is wicked smart and wicked successful. It's kind of risky, but he does more of that, where, he comes on this channel and says, all right, I think Q1 is going to peak. I think Q2 will be down about 15%. I think Q3 will be up to new highs. I think Q4, we're going to hit a new low. So, you guys, but Felix is managing his own money, so he doesn't have to worry about disappointing anybody if he happens to be wrong. You guys have to be very careful. So I want to give both you guys the credit you're due there.
No, and look, and don't get me wrong, it was a very friendly debate. You couldn't even call it a debate. We just had a conversation, and we laughed at each other.
Two smart guys talking. I mean, I think that's better than a debate in many ways.
It was a lot of fun, and I would love to do it again with him sometime. Yeah, I'd love to maybe with you, him and I get on where we have a little bit longer discussion. There were some technological issues with the debate, so he couldn't get access to charts. I was having trouble with their technology getting my charts up. So, but maybe we could do something like that, kind of go into more detail on some different things. But again, the overall, the only thing I really disagreed with him on, and is from the function where he said that he doesn't think during the next correction, I said this earlier, is that he doesn't think the Fed will step in. I absolutely guarantee you the Fed will step in. And especially if it's impacting the banks, and that's going to cause inflation to go lower. So, but that's out of all the points, really the inflation and Fed thing was about the only thing we actually disagreed on.
All right. Well, if you guys do want to explore that or any other topics in greater depth, yes, you're more than welcome to do that here on this channel anytime. Folks, if you'd like to see that, let us know in the comment section. All right, Lance. It's getting to that time. We got to start wrapping things up. I want to give you a chance to give any holiday wishes you want to give to folks too before we wrap up here. But I want to end on something that hopefully will be, a little bit uplifting than maybe some of our other rants. It's a, I'm just trying to pull it up here. It's a tweet that my wife sent to me this morning, and it's interesting because she's really not a big user of X. But are you able to see this, Lance?
I am.
Okay. So she just texted this to me. She saw it online and it resonated with her. This is from a guy named Justin Welsh. I don't know what his background is, but he says success, and then he has 5 factors for it. Number 1, build something small you enjoy. Number 2, invest in quality, but live modestly. 3, keep the majority of your time free. 4, spend that time on health and family. 5, ignore society's definition of, quote, making it. Do these 5 things well, and you'll live a better life than 99%. And she texted to me and said, hey, I think we're doing pretty well.
Yeah.
And I responded saying, I think we're 5 for 5 in the way that she and I have designed our life over time. Took us a long time to get to this stage. But I thought that was a really good summation of a recipe kind of for a fulfilling, happy life. So you're nodding as I'm saying this, Lance. A couple of things I want to mention about it briefly, and then I'll let you chime in. Let's see, where did I have this? If you look at those things, they pretty much are the 3 things that I keep hammering home on this channel, what true wealth is, right? It's relationships, it's purpose, and it's health, right? And number 1 on this guy's list, build something small that you enjoy. That's very much, I think, a way of finding meaning and purpose, right? Like, build something that, or spend your time in a way that you are doing something that's meaningful to you and that you have control over. He didn't use the words control, but I wanted to just lock in on control for a second. Because not everybody, to be happy, has to go become an entrepreneur and start their own, small business. I think you can be very happy inside of a larger corporation. In fact, we need to have people that run our big companies. So, if you're wired to be a CEO of a large company, great. We do need them. But I think the key factor in this thing is control. It's the ability to spend your time the way that you think it should be spent and not having to jump to somebody else's tune. And, I think back to my days working in corporate America. My last job, as I mentioned a lot in this program, is I was VP of marketing for North America for Yahoo, which was a very big job. Um, but when I look back on it, I had a lot of responsibility, but I didn't have a lot of authority. Like the way in which I spent my time was based on having to talk to the executives above me and say, look, this is what I'm planning on doing, and getting their input, and essentially having them approve or disapprove what I would then have my team go out and do. And I felt constrained because I didn't feel like I had full control over my time and my priorities. Um, and once I went solo and started my own thing, it was very, very small. And that was an issue I'll talk about in just a second. But I had full control over it. And that feeling of waking up and saying, hey, everything I get do today is going to be because I think it's the right thing to do at the right time, is an incredibly liberating and incredibly fulfilling feeling. One of my mentors, good friend of mine, Charles Hugh Smith, who you folks who watch this channel, probably a lot of you know Charles. He has said many, many times to me over the years, if you don't have 100% control, you've got 0% control. And he, like many other entrepreneurs that I talk to, they basically will prioritize control over financial return, where they will say, look, if I'm running, my business, if I'm running my life, if it's a decision between making a little bit more money but giving up control to somebody, every single time I'm going to pick control versus making the extra money, because losing control always comes back to bite you in the end. And it just makes you less happy and less fulfilled. You're not driving on your agenda, you're driving on somebody else's. The last thing that I'll mention here is small. Now, again, it doesn't have to be small. Again, if you're more motivated to build something big, run a division of a larger company, run the larger company itself, great if that's how you're wired. But for most people, the smaller something is, the more you have control over it. And so those things are fairly correlated. I remember when I left Yahoo and I was really trying to wrestle what I was going to do next. One of my biggest limiting fears at that time that I really wrestled with was I wanted to go do something much more authentic, much more, true to who I am. But I had this worry in my head, this fear, this resistance that, okay, but I've got this quote unquote big job right now. It looks impressive. I went to Stanford Business School, and that's more the type of job that somebody who gets coming out of Stanford Business School. If I go start my own little thing, what if what's truly authentic to me is small in a way that my peer set would look at and say, really, you're doing that with your time? And I really had to overcome that bias. And one of the things that I heard, I think I've mentioned this once or twice before in this program, that really freed me was, as part of a maturing adult, healthy maturing adult, you have to make the mental shift from living a life based on others' expectations of you to living a life based on your own expectations for you. So it's kind of like, forget what everybody else thinks. Like, what brings me happiness, right? And if you can do that, then yeah, it doesn't matter what the size is, big, small, whatever. If it's where you're supposed to be doing what you think is important and resonates with you, that's really all that matters at the end of the day. So anyways, Lance, I'll take my pause here, but I can imagine that those 5 things, I mean, I kind of look at your life and I think, yeah, I think Lance has kind of nailed this.
Yeah. Well, no, I mean, it's absolutely right. I mean, I've been in business for myself for a long time, and it's very, once you work for yourself, it's very hard to go back to working for somebody else, and because it does give you a lot of freedom, and then when you can build some success, you can look and say, yeah, I did that, versus, great, I worked this job all day long and the company's getting successful and I'm still getting the same paycheck, right? So
right, I did it because somebody told me to do it, and somebody was
yeah,
getting the majority of the benefits out of that. Yeah.
yeah, and that's why there's a lot of, kind of a lot of negative sentiment towards, corporations these days, and they don't share the wealth and all these type of arguments, and we can go through those later. But, the reality is that if you really want control in your life, you have to work for yourself, and you do have to maintain control. The biggest challenge, and the one thing that, as an entrepreneur, it's just like being married. If you get into a bad marriage, you're going to wind up divorced. If you get into a bad partnership with somebody, you're going to wind up divorced. So if you, and I encourage anybody that I've talked to that, I get a lot of people who come and say, hey, I'm thinking about starting my business. What do you think? Blah, blah, blah. And I'm like, go bootstrap it. Go do it yourself. Go live in an apartment, whatever you got to do, but just fund it yourself. Don't go out seeking other people's money, because once you do that, you give up a ton of control and you're now really kind of in the employee position rather than the owner position.
Can I just make one comment? Because I want you to riff on this, which is, not everybody is wired to be an entrepreneur.
Yeah.
I'm not trying to denigrate anybody that's working in a company and has an important role there, right? And so I think on this element of control, yes, a perfect manifestation of it is the solopreneur. But
Right.
I think I look at it as doing spending your time on your terms. And I think you can be a high value contributor within a company and still do it on your own terms, where you basically say, look, I'm going to run this division this way. Yes, I'll listen to your input, but based on my expertise and what I think is right, I'm going to do it this way. And if you disagree with that, if you've got higher ups that are like, no, that's not what we do, fine, I'm walking. I've got the ability to do this somewhere else, right? And so if you can get to that stage,
Yep.
I think that's fine. If you
No,
want to be a division manager somewhere, great.
right. And if you've got the ability to have that kind of position within a company, then yeah, you have control over that position, because it's kind of like with my wife, right? What she does, her job is very transportable. So if her company doesn't treat her well, she'll say, okay, well, fine. I've got 15 other companies that will hire me like that for my particular skill set, because she is phenomenal at sales, and everybody needs a salesperson, right? It doesn't matter what business you're in, no matter what your structure of your company is, you need salespeople at the end of the day. And if you got to sell a product or a service, you need to have somebody that sells. And so when you got that kind of a skill set, you have a lot of control. If your skill set is not highly evolved, you have a lot less control. And so, this is one of the complaints I have, and you and I have talked about, the issues of minimum wage and all those type of things. If you're working for minimum wage or a very low wage, that is a moment of self-evaluation, because at that level, you have not evolved your skill set yet to a valuable skill set. Otherwise, you'd be making more money. So this is where you need to look back at yourself and say, okay, I don't want to be here forever. What do I need to do to get to some level of better control, and then start building that skill set? Whatever it is, in whatever field it is, build that skill set. You can do it. You can, there's, it's amazing now how many online courses there are. You can get whole college degrees through YouTube pretty much, with all the online education there. So there's no excuse not to build your skill set to put yourself in a better position to both be in control and earn higher incomes.
I totally agree.
That's exactly where
yeah,
right.
It's exactly where I wanted to go with this conversation. And my message here, I think, to people through this positive rant that we're doing here is really look at this element of control and ask yourself, do I have the control that I want to have, right, to be happy and fulfilled? And if I don't, am I on the trajectory to get more? Or if I'm being honest and look around here, maybe I'm not, right? And if not, then what can I do about that? Because I think that control vector is one that doesn't get talked about nearly enough, but when it really comes to fulfillment, it's a critical one.
Yeah. And look, and we talked about this before. I mean, if and this is crucial, is to look at the people you surround yourself with. And that's not just in your circle of friends. If your circle of friends are all a bunch of losers, you're going to be a loser, right? I mean, just look at your friends, and that's where you're going to be in 5 years, because that's your circle of influence.
Right. This is the average of the 5 people you associate with. Yeah.
But it's the same thing at work. If you go to work, if you're at a job and you look around the people you're working with, and they're not in a position where you eventually want to be, I would start trying to figure out a different avenue to get myself into a work environment that gives me the ability to grow. Because if everybody in your current work environment is going nowhere, you're not going anywhere. Yep. That could be a management issue. It could be a whole lot. It could be a structural issue. It could be an economic issue, whatever it is. But you're probably not going to go anywhere from that position, because they're not going anywhere. So you want to make sure.
If you're stuck at a Dunder Mifflin, not a great place to advance, right?
Yeah. So put yourself in. So even if you've got to take a pay cut to get yourself into a company where the people above you are excelling and the people above them are excelling, they're eventually going to pull you up. But you're going to have to show up, but having said that, you've got to show up early. You've got to work late. You've got to put in the time. You can't be taking time off. You can't be complaining. I mean, you've got to go in and really excel at what you're doing and become a valuable member of that team, and they will lift you up. But you've got to prove yourself in that process as well.
Completely agree. Two things to add into that. One, I think I've mentioned at least once before on this program, but it's worth re-mentioning, which is just as a company has, a lot of big corporations have a board of directors, right? The whole rationale of having a board, more or less, is to have to leverage the wisdom of the collective of really smart, successful people, as opposed to just betting on one person, the CEO, right?
Right.
I think we, all of us in our professional and personal lives should recruit our own board of advisors, right? Which is, hey, who are really smart, successful people of the type I want to be like? And then, this is recruiting your new group of 5 people. They're just your expert mentors, right? And leveraging their brain power and their goodwill, right? So in most cases, most people would be honored to be asked. You have to be careful not to abuse it, but just say to these people, look, I'm really looking to get better at what I do. I really respect your accomplishments and expertise in this area. And I would love the ability to be able to tap your brain occasionally on key decisions that I'm wrestling with, right? And I would say 9 times out of 10, people are going to say, wow, I'm so glad you asked me. I'd be happy to do that, right? Again, you can't abuse it. You can't be bugging them all the time. But it's such an easy thing to do that can be a real force multiplier that I think almost nobody thinks to do or feels like, oh, I couldn't possibly ask that person, right? And I can't tell you how many times I've availed myself of just reaching out and asking and been just shocked and amazed at how beneficent people have been willing to be with their time and their expertise. And I try to pay it forward as well when people reach out to me. And I know you do that a lot too, Lance.
Yeah, I have a mentor that I've known for 25 years, and I have lunch with him twice a year. And that's the only time I see him, right? The only time I call him, the only time I see him is twice a year when we have lunch. I take him to lunch at a really nice restaurant, treat him right, pick his brain for an hour or so, and then send him on his way so he can get back to work. He's very successful at what he does. But I never leave there without having just a ton of new insight. He's not that much older than me, but he's just been very successful in life. And again, the thing that you get from people like that is that they've all been through the school of hard knocks. And when I was young, I remember when I was young, I was trying to raise capital for my first business. And so I go talk to really rich people. It's like, hey, people have a lot of money. These people have a lot of money. They'll give me some money. And they're like, no, yeah, I'm not interested. And so for the first few times I got rejected, I was like, okay, fine, whatever. And I just walked out. Well, I then realized I went back and I started saying, okay, why did you reject me? And they're like, oh, well, because you didn't have this in place. And I was like, oh, I didn't even know about it at the time. I was whopping like 22 years old trying to raise $1 million to build a fitness facility for a corporation. And, I was going to the bank and the banks were like turning me down left and right.
Yeah.
And so when I started asking the right questions, then I started getting myself in the position of being able to raise the capital. And as I kind of kept going through that process, I started just asking more questions. Well, why are you saying no? And, it's because they've been through deals where they've loaned money to people, they didn't pay them back, the deal turned out bad. And because of that experience, they learned all the things to look for in making sure that a business was going to be a successful investment for them. And so once I could answer all those questions, it became extremely easy to raise capital. And so, now, here I am 60, I look back and when people come to me now and ask me for money, I'm like going, well, no, because of A, B, all the things that, I've learned over 40 years of, building businesses and investing in them, et cetera, and losing money, having bad investments. It happens. It's a function of life. But now all that experience gives me a really good ability to analyze a business, analyze, most importantly, the character of the person I'm going to business with. And that's the one thing that really rich people are really good at is analyzing your character very fast.
Right. Yeah.
And so once you kind of start to learn that, it becomes very easy to start putting things together. But you know, so don't. So that's the whole point, though, is when by having some mentors that you can go talk to. Hey, I'm thinking about doing this. I wouldn't do it. Well, and here's why I wouldn't do it, or I wouldn't do it that way, and here's why. Because I've been down that road, or they've been down that road, and they know where that road ends. And so listen to them, and don't do that. Right? It's just
Like I said, it's a force multiplier. They're giving you decades of experience. It can really save you decades of making the dumb mistakes, right?
I wish my kids would learn that idea, so when I tell them no about stuff, they would understand why I'm telling them no. But
Yeah. They will, and of course they'll say, "Oh gosh, Dad, I should have listened, to you years ago." But that's us fathers don't get that until we're a bit older. So I still got one more thing to mention, but you mentioned something else that might even be its own discussion in the future, which is the ability to ask the right questions. Um, I remember I had this just seminal moment in life where had a girlfriend whose father was a very successful businessman, and he was I can't remember the context of the conversation, but I was asking him about his success and his business that he was most sort of famous for, and he said, "Well, I was working with the engineers, and we came up with a solution," and I was just like, "Wow, like." How did you know how, like, I know nothing about engineering, right? Like, I would have no idea how to engage with an engineer. This is, when I was just out of college. And engineering at that time was just cryptic black magic to me, right? And he said, "Well, I didn't know anything about engineering." And I said, "Well, how were you able to be successful with them then?" He said, "Because I knew I figured out what the right questions to ask were." And I really thought about that in life, and I realized, oh my God, like you don't have to be a domain expert in everything. You just need to know, what's the thing you're trying to solve for. And so how can you ask the right questions to all the people who know all the answers to get the thing you want solved. And I really honed that skill when I was working at Yahoo, and a lot of my roles there, I was kind of the center of the wheel and a lot of project management, product launch type things. And I think what I really developed to do well there was to figure out, okay, what's the right question to answer of the guy who's got the domain expertise to give me the right answer. And I think in many ways, that's what sort of led me to do this here at Thoughtful Money is if I do my job right here, I'm not the expert. My job is to find the right questions to ask the experts so that we can get, the insights that the audience most wants to hear. And if you can learn to do that and work on that skill, it is like a superpower.
Um, but yeah, one of the things I learned early on in life is that if when I was doing stuff, when people say, "Well, do you know how to do that?" Absolutely. Even if I had no idea how to do something, absolutely I know how to do that. And then I would go learn it really quick, right?
Yeah.
So, and so you should never, like, if you're applying for a job and it's like, I really would like to work for this company, and it's asking for some skill set you don't have, go learn it. I mean, as I said, it's not hard to learn a new skill, and there's so many tools and available. We all have these things in our hand called cell phones that we just text mean things to people we don't know. But there's so much knowledge if you actually put this tool to work that can improve your life just on multiple points.
Totally agree, but let me just add something else to that, though, which is I think another superpower is to say, I don't know, is to feel comfortable saying, I don't know. So if you're with smart people and they're using terminology you don't know, or they say, oh, well, as so-and-so said in this book, right? You read that book, right? If you didn't, don't just nod and pretend like, oh, of course, because I don't want to admit I'm ignorant on this. Say, no, I'm sorry, I don't know, because that is the fastest way to learn, right? So I totally get your point, which is, a lot of times you want to fake it till you make it, and you want to project confidence. And yes, if you can go get the answer and come back with it, great. But if you truly don't know, when you're around smart people, don't be afraid to let them know that you don't know. If you can say, oh, wait a minute, you used a term, I hadn't heard that before. Do you mind just explaining that before you continue? That is by far the fastest way to learn. And the people I've witnessed who are too timid to say that, their progression trajectory is at a much lower angle of altitude than people that are willing to say, "Oh, I'm sorry, can I learn something here from you?"
Yeah, no, absolutely.
Yeah. All right, my last point, and then we'll wrap up here. I just feel like we're just tossing pearls of wisdom right or left here today, Lance. Maybe the audience doesn't think so, but this is all the stuff I wish my kids like you, would
I
integrate.
wish, I wish my kids would just listen to something.
But the last thing is when we talk about control, we want to do all the things that you mentioned about upgrading yourself and putting the hours in and all that stuff. But another thing you have to really work on to exercise your control is to flex it, right? Is to know how to put when and how to push back, right? So control means doing what you think is right. And so at some point you have to dig in your heels when you think you're being pushed to do something that you disagree with, right? And I'm not telling people just to be stubborn or ornery by nature, but most people don't like confrontation. Most people go with the flow, especially if you're working inside of a corporation, right? You have to learn over time to say, hey, you've got an opinion, I've got an opinion. We disagree here. We can disagree diplomatically, but I'm going to continue doing it this way because given all the information I have right now, I believe this is the right way to go. And if you don't do that, people will steamroll you, and maybe not even necessarily in an evil way, but they just have learned that, oh yeah, this guy's a pushover, and I can just, he always does what I tell him to do, and that's my expectation of him, right? And eventually people, when you initially push back, it's going to shock them because they're not used to it, and they probably won't like it initially. But if they understand that, oh, okay, well, Lance has got a backbone. He's got a backbone because he's a smart guy who's come up with a way I can't argue him out of because it makes sense. Oh, all right. Well, yeah. All right. Well, let's do that then. So you have to develop that muscle of being able to push back in a firm but diplomatic way.
Yeah, absolutely. I mean, but unfortunately, in society, we raise people to be sheep, and so we're not trained and we're not taught how to do that anymore. I mean, and back when you and I were growing up, we were taught to solve problems, right? And so whether it was working it out on the playground or whatever it was, that's just the way that our generation was brought up.
Right. I would say less taught to solve problems and more just benign neglect, like we were just left alone and had to solve them.
Exactly. Could be that way, yeah. But today, everybody's just so afraid to say anything because, it's like, oh, I don't want to say something on Twitter because somebody might, lash back at me. Oh, so what? Right? I mean, we're so afraid of having our feelings hurt that it's really eroded that capability for somebody to stand up for themselves because they're afraid to stand up for what they believe is right because they're afraid of what everybody else is going to think. And that's the first step to failure, because once you're not willing to step in front of the train, so to speak, and stand up for A, what you think is right, or B, what you want in life, you're never going to get there, because in order to get to where you want to be, you're going to have to piss some people off. You're going to have to do things that people don't want you to do. You're going to have to separate yourself from the pack, right? And those all require that ability to take a hit, because you're going to be taking a lot of hits to build success. It doesn't come pain-free. And if you want it, you can do it, but you've got to be willing to have those tough moments where people aren't going to like you. People aren't going to say nice things about you or whatever it is, because they're hurt because you're succeeding and they're not. And so they're going to lash out at you because of that. And they're going to call you bad names and they're going to make up stories about you, whatever it is. You can't worry about that stuff. You've got to focus, and you've got to be doing the right thing, right? If you're being a criminal, that's a different story.
Right. If you're being a jerk about it too. Yeah. No,
yeah. But if you're doing the right things and moving in the right direction, you're going to get hate for that. People are not going to like you because you're successful. That's just part of the deal, and you've just got to get used to that.
So the theme, obviously, of I think all these things we talk about, Lance, is it's resilience, right? And to be resilient, you have to be willing to absorb blows when the world throws them at you. This last point also builds off your point from I think last week or the week before about how saying no, the ability to say no, is critical to success, and it's a superpower, right? When you get to the point where you can say no, to things that would otherwise distract you, so that you can focus on the things that really matter. Definitely another force multiplier. Yep. All right. Well, look, folks, if the biggest way you can exert control over your happiness in life is to commit to continuing watching Lance Roberts on this channel week after week, let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. You know, I say this every year, so I'll be short this time, but if you want to get some professional guidance and help in terms of how to position your portfolio for the type of future that we might be heading into, a year next year that might not be as pleasant for investors as the past 2 years has been, as Lance has explained as many reasons for, then highly recommend you do so under the guidance of a good professional financial advisor. If you would like to benefit from the expertise of one of the ones that come on this channel with me week after week, perhaps even Lance and his team there at Real Investment Advice, then go to thoughtfulmoney.com, fill out the short form there, and within no time at all, the advisors will reach out and schedule a time to have that consultation with you. All right, Lance, my friend. Oh, sorry, real quick. I got to remember, while you're there at Thoughtful Money, don't forget to hit the newsletter link at the top of the website, sign up for our free newsletter. And if you've been waiting to upgrade to premium, you got to do it now because the price is moving up at the end of this year. So you only have what, like a little less than 10 days left before the price goes up. Anybody who signs up now will be grandfathered in at the current price. And just a reminder, if you signed up last year at the even much lower price, you're going to be continued to be grandfathered into that price. So I want everybody grandfathered in at the best price that they can get in at. Lance, my friend, we'll let you have the last word here. And of course, this is the last weekly market recap before Christmas. So feel free to give folks your holiday wishes.
No, absolutely. And in Texas, where I live, we say Merry Christmas. So I wish you and your family a Merry Christmas. And to all those that are watching, Merry Christmas to you. Many blessings to your family. Have a wonderful holiday. And we'll see you after Christmas.
All right. Thanks, brother. Merry Christmas to you too. Everybody else, thanks so much for watching.